So, and then, what should reasonable compensation be? What if what if they are just massively profitable? It's just single shareholder. Do you stop at the Social Security cap? I've heard that a lot. I don't, I don't think so. But for purposes of just tax savings, that is where it kind of just drops off, right? You still got Medicare tax going on, but it's not as big a deal. So, it's just, yeah, there's just honestly, it's just kind of gotten kind of frustrating trying to like go through all the different components of it, because this was all supposed to make it so much simpler. It's made it so much more difficult. But yeah, I think that's the best approach, David. To your point and your comment here is the best way you can go about doing this and thinking about it for yourself and your clients is to just start modeling it out in a spreadsheet. So one of the very first things I had to do when I started my firm under my mentor, and by firm I mean I had a handful of clients uh, that first year. Then we moved, and I got a job with a local firm, very small local firm, and uh, worked there for a tax season and learned just how to do a lot of 1040s just real quick. All right, that's fine. That's one aspect of this business, this job. But then after that, I started working for a startup that was advising small business owners, independent contractors, freelancers, this sort of stuff. And a big part of what they were selling was entity planning, S elections. And so we needed to be able to do this kind of analysis. And 199 Cap A was a new thing. And so I just started building out a spreadsheet. And at first, it was terrible. It was just the most awful spread. I mean, it couldn't have been accurate within 20% of what the actual tax liability was going to be, but it was a start. It was a first cut at it. And I was just trying to figure out what will the federal tax liability and what will the California liability. The startup was only working in California at that point, and what will the California tax liability will be. And over the next few weeks and even into months, I just slowly made it more and more complicated, right? So let's add in tax brackets and do that instead of just, a flat rate. Let's add in 199A, and try to figure out what is that deduction going to look like. Let's add in SEP or solo 401k, and if they want to contribute into that. And I tell you what, it was time consuming and it was annoying, but I learned a lot about spreadsheet formulas, and this was pre Chat GPT, so there was no way to just tell Chat, which is what I do now a lot of times. I just tell Chat, I need a formula that will do this for me, and it just kind of spits something out. It usually doesn't work, but after a few minutes fiddling around with it, I get it to work. But building that spreadsheet out, it really taught me how, all the different interconnections between all these things are. Because if I could put the numbers into the spreadsheet and then I could put those same numbers in the tax return software and see how far apart I was, right? And I was usually off, but over time it got closer and closer,
Yeah, and
to where
that's
it
what
should
we
be.
were running into. I'm
Yeah.
like, oh, there's a good benefit. Oh, wait, we're off by 5 grand. What's
Yeah.
going on here? Oh, we
Yeah.
have this limitation. We have that
Oh,
limitation.
because there's this thing over here. And it's like,
Yeah.
yeah. And that's when you get into like the statements and the worksheets in the tax software. And you're like, oh, there's this calculation out of some IRS publication that I forgot all about, that I got to put in here too. And then you kind of think, okay, do we really need this for planning purposes? Like, do we need to be dead on accurate, or do we just need to be within, maybe a couple $1,000? And you just refine that process over time. And like I say, that's where I really learned like how these different things interact with each other and what the implications of them are. It's one thing to just prep a lot of returns when the inputs are already given. It's another thing to build out this model, and it was kind of a good process, good learning process for me. So, yeah, I think to your point, yeah, just keep modeling that out. Keep working on that, and you're absolutely right. Just that we're going to get self-employment tax savings. Oh, but then, we've got to think seriously about what reasonable comp is. Oh, but then we got to take 199A into account. Oh, but then, we got to take state taxes into account. And it does whittle away at those savings. And then finally, don't forget to take into account those administrative costs as well. Because again, I don't think it's fair. Like a lot of the marketing for, I'm not saying anybody here does this. What I'm saying is like the marketing for these services that I see online, or some of the the kind of influencer accounts on social media that are pushing things like S corporations. It's just the self-employment tax savings. That's all they mention. They never mention the fact that you're going to need help to actually make all this happen. And that's going to cost you money too. So yeah, it's not easy. They're the magic spread. Yeah, the spreadsheet. That's right. Yeah, I mean, at the end of the day, it's just you got to just build this out and model it, in a spreadsheet for yourself and your client. Also take into account what income we can shift as well. Yeah. Yep. Matthew, if you have a subscription to RC Reports, there's an entity planner that includes all this, but I don't know how easy it is to use for multiple shareholders. Now that, yeah, a lot of this is all based on the context of a single shareholder, which a lot of, I want to, I saw some statistics on this a few years ago, and the way IRS is with their statistics, that means they were actually statistics for a few years before that. So this is probably all, 10 years old by now. Um, but yeah, of course, the vast overwhelming majority of S corps are solo. Um, some of them have 2 to 5 shareholder. It's funny. The whole 100 shareholder limit is just because I mean that I have yet to meet any business that would be anywhere near thinking about an S election that had more than 100 shareholders or LLC members or whatever. But yeah, the vast overwhelming majority of them have fewer than 5, most of them just 1. But when you bring in that second shareholder, if they have an unequal ownership, if they're in different states, if their roles in the business are different enough to where their salaries really shouldn't be equal, all of that is going to make this even more complicated. Thinking about all that. Yeah, Jolie, talk about how an S corp can unwind and become an LLC. Okay. Yeah, that's a good question. It's something that I see a lot because, and we're having to, like I said, we're having to think about this with um, some of our clients as well. So there are uh, trying to think. I mean, off the top of my head, I can think of 3 different ways. The first way only applies if the corporation has not reached the due date of its first return yet. Okay. So this is only available, like, let's say that the election is made this year and effective 1/1/2025. So when is its first tax return going to be due? March 15th of 2026. So anytime between now, if that election has already been made and accepted, anytime between now and March 15th of 2026, you can withdraw the election. And and I think it's actually not available because of the way uh, a lot of the IRM was taken off the website. But if you're ever looking for something in the IRM and it's now it's there, but it's now missing because of the way a lot of the government websites got messed with over the last few months. If it's been taken off the IRS website, if it's missing, you can find uh, all of the IRM, at least as it was prior to January. You can find all of that on tax notes. They have the entire IRM saved as it was back in January. But there's a part in the IRM where it discusses withdrawal. Withdrawal basically means you send written correspondence into IRS requesting that the S election be withdrawn. IRS accepts that generally, and it's as if the election never happened, which is a good thing if you didn't really want that election. But like I said, once you have hit the original due date for that first tax return, that's not an option anymore. So that's only for that first year, up until the very first. due date for the very first tax return. After that, your options are essentially either revoke the S election, which means filing a final return. You also need to send in a written notice of revocation to IRS. There are guidelines for what that there's guidance on what that should actually look like. Here's the thing though. The real quick, the third way is an automatic, uh, not revocation, but basically just you blew the S election. Now there are some cases where the S election is intentionally blown, but I've never dealt with a case like that. I've only heard some stories over where that might have actually made sense. But in general, if the corporation unintentionally basically does something that violates the rules of S corporations, then that can blow the election. The election is invalidated, and now that's the other way you can get rid of that election. But here's what happens, because if you're talking about an LLC that elects to be an S corporation via Form 2553, that's actually two elections in one. It's a C corporation election first, and then it's an S corporation election. So when we talk about a C corp election, we're thinking Form 8332, but that's not actually what happens. In fact, I've seen a lot of cases where somebody is still filing both forms, thinking both forms have to be filed. That's not true. The 2553 gets you to an S corporation, from an LLC to an S corporation. You don't need the 8332. You just need the 2553. But when you revoke, now withdrawal, if you just withdraw the election, it's as if the entire election never happened. So none of what I'm about to say applies to a withdrawal. But again, that's up until you get to the due date of that first return. If you revoke the S election, so you're past that point, then what you've actually done is you've revoked the S election, but now that entity is still treated as what the Treasury regulations call an association. So the first election is to treat that entity as an association, which by default is a C corporation, and then you're electing to treat that association as an S corporation. So if you revoke the S election, you're only revoking the S election. So now you're back to an association.
Thanks so much for joining us. We really hope this session was helpful for you. If you enjoyed this and want more support on your tax professional journey, consider joining one of our Pronto Tax School memberships. As a member, you get to join weekly live mentor sessions just like this, access tons of advanced tax courses, be part of our private member groups, which is great for networking, grab special discounts for our live events, and even get tax business growth coaching. There's a lot packed in. Check out the links in the description to see the details for our Dream Team and Forever Edition memberships. We'd love to have you join our community.